Every bull market has its heroes. Some are obvious. Banks, IT companies, defense stocks, railway companies. And then there are companies almost nobody talks about. Yet they quietly manufacture products that thousands of industries simply cannot function without. Balaji Amines is one of them. Most investors have never heard of methylamines, or ethylamines, or specialty amines. But chances are, the medicines you consume, the crop protection chemicals that increase food production, the water treatment chemicals that keep cities running, the rubber in automobile tires, even the dyes and pigments used in everyday products, all have one thing in common. Somewhere in their manufacturing chain, amines play a critical role. And in India, one company dominates this niche, Balaji Amines. But this isn't just the story of another chemical manufacturer. It's the story of a company that quietly built technological leadership in one of the most difficult segments of the chemical industry. Because manufacturing amines isn't easy. The chemistry is complex. The process requires precision. The capital investment is substantial. And the safety standards are uncompromising. That creates one of the strongest competitive advantages any manufacturing business can possess. High barriers to entry. While many companies can import chemicals and trade them, very few can manufacture them efficiently. Even fewer can continuously develop new derivatives. Balaji Amines did exactly that. Over decades, it transformed itself from a regional chemical producer into India's largest manufacturer of aliphatic amines and methylamines, becoming the only domestic producer of several specialty chemicals that were once dependent on imports. That leadership wasn't built through aggressive acquisitions or flashy announcements. It was built one molecule at a time, one process at a time, one plant at a time. Today, Balaji Amines supplies products to industries that rarely slow down. Pharmaceuticals, agrochemicals, water treatment, rubber chemicals, specialty chemicals. These aren't luxury products. They're industrial essentials. And that's what makes this business interesting. When you manufacture a critical input rather than the finished product, you're not dependent on a single customer. You're embedded across entire industries. This creates diversification that most investors don't immediately notice. But leadership alone doesn't make a great investment. Timing does. Because even the best businesses go through difficult periods. And Balaji Amines was no exception. Just a few years ago, the company looked unstoppable. Revenue surged. Margins expanded. Return on capital crossed levels that many businesses can only dream about. The stock became a market favorite. Then everything changed. The global chemical cycle turned. Chinese manufacturers flooded international markets with excess supply. Prices collapsed. Customers began reducing inventory. Exports weakened. Profitability fell quarter after quarter. Margins shrank. Return ratios deteriorated. Investors, who had once celebrated the company, started questioning its future. The stock entered a long and painful correction. For many, the story appeared to be over. But markets have a habit of doing something remarkable. They often lose interest in businesses precisely when the foundations for the next cycle are quietly being laid. And that's where Balaji Amines becomes fascinating. Because while earnings were under pressure, management wasn't retreating. They weren't cutting investments. They weren't abandoning growth. Instead, they were preparing for the next decade. The question every investor must ask is simple. Was this merely a temporary downturn in a cyclical industry? Or was the business itself losing its competitive edge? The answer to that question could determine whether Balaji Amines becomes just another recovery stock, or one of the next leaders of India's specialty chemical sector. And to understand that, we need to look beyond the headlines, beyond the quarterly numbers, and into the strategy that management was quietly executing while the market was looking elsewhere. Because sometimes the biggest opportunities are created not when everything looks perfect, but when a great business is rebuilding in silence. In the next chapter, we'll uncover why Balaji Amines continued investing hundreds of crores during one of the toughest periods for the chemical industry, and why that decision could shape its future for years to come. The story behind India's silent chemical giant when everyone stopped believing. Every industry has seasons. There are years when demand is strong, prices keep rising, and profits seem effortless. Then there are years when the cycle turns. Factories continue running, products continue selling, but profits begin to disappear. The specialty chemical industry is no different. Around the world, the sector entered one of its toughest phases in decades. China, the world's largest chemical producer, emerged from pandemic restrictions with excess manufacturing capacity. Domestic demand remained weak. So Chinese manufacturers did what they have done many times before. They exported aggressively at prices that many competitors simply couldn't match. Global chemical prices fell. Customers stopped building inventories. Instead of placing large orders, they bought only what they immediately needed. Export markets slowed. Across India's specialty chemical sector, companies that had reported record profits only a few years earlier suddenly found themselves facing shrinking margins and slowing growth. Balaji Amines wasn't immune. Annual revenue declined from more than 2,300 crore rupees to nearly 1,400 crore rupees. Operating margins compressed. Profits almost halved. Return on capital, once among the best in the industry, dropped sharply. On paper, the numbers looked disappointing. Investors reacted exactly as markets usually do. The stock corrected. Optimism disappeared. Research reports became cautious. Many assumed the company's best days were behind it. But here's what separates great management teams from average ones. Average management protects today's profits. Great management prepares for tomorrow's opportunities. While many companies delayed investments, Balaji Amines chose a very different path. Instead of slowing down, it accelerated. Management understood something that long-term businesses rarely forget. Chemical plants aren't built overnight. From planning and environmental approvals to engineering, construction, testing, and commercial production, a single project can take years. If you wait for demand to recover before investing, you've already missed the opportunity. So while earnings were under pressure, construction cranes continued moving, capital expenditure increased, new manufacturing facilities were approved, existing plants were expanded, and one of the biggest investment programs in the company's history quietly took shape. The company announced an expansion pipeline worth nearly 750 crore rupees through its specialty chemicals subsidiary. Not because business looked perfect, but because management believed the next chemical cycle would reward those who prepared early. These weren't random projects. Each one targeted products with higher value addition and stronger entry barriers. Hydrogen cyanide, sodium cyanide, EDTA, acetonitrile, N-methyl morpholine, dimethyl ether. Names that sound technical, but represent products used in pharmaceuticals, agrochemicals, mining, water treatment, specialty manufacturing, and several industrial applications. More importantly, many of these products are still imported into India. That creates an opportunity. If domestic manufacturers can produce them efficiently, they don't just replace imports. They strengthen India's chemical supply chain. One project is particularly interesting. The company's dimethyl ether plant. At first glance, it sounds like just another chemical. But dimethyl ether has the potential to replace part of India's LPG consumption in industrial applications and aerosol products. India imports enormous quantities of LPG every year. Even a small shift toward domestic alternatives creates a meaningful opportunity. Recognizing this, the Bureau of Indian Standards has already introduced standards for blending DME with LPG, while oil marketing companies are evaluating broader adoption. That doesn't guarantee success, but it creates a market that barely existed a few years ago. The same thinking appears across Balaji Amines' expansion strategy. Don't compete where everyone is competing. Build capabilities where technology matters, where imports dominate, and where customers value reliability more than the cheapest price. This is a subtle shift. The company is moving further up the value chain, from commodity-like chemicals towards specialty molecules with better pricing power and stronger margins. Of course, expansion always comes with risk. Large projects require capital. Delays are common. Demand forecasts can be wrong, and returns take years to materialize. That's the gamble management is taking. But because Balaji Amines enters this expansion with a remarkably healthy balance sheet and very low leverage, it has something many competitors lack: the financial flexibility to invest during difficult times instead of merely surviving them. History often rewards companies that expand when others hesitate. Not immediately, but when the cycle finally turns. The question now is no longer whether Balaji Amines survived the downturn. It clearly has. The real question is whether these investments will transform the company's earnings over the next 5 years, or simply increase capacity without creating adequate returns. In the next chapter, we'll examine the financial statements, the balance sheet, and the latest quarterly results to see whether the first signs of that recovery are already beginning to appear. The numbers are finally beginning to speak. In the stock market, price tells you what investors believe. But financial statements tell you what's actually happening. And sometimes, the two tell completely different stories. For nearly 3 years, Balaji Amines' financials reflected a company fighting one of the toughest business environments it had ever faced. Sales slowed, margins contracted, profits declined, return ratios fell sharply. If you looked only at those numbers, you could easily conclude that the company's growth story had ended. But experienced investors know something important. Markets rarely wait for perfect financials. They move when the direction begins to change, not when the destination has already been reached. So the real question isn't whether Balaji Amines has returned to its peak performance. It hasn't. The real question is, has the decline finally stopped? And that's where the latest numbers become interesting. The March quarter wasn't just another quarter. It looked different. Revenue began growing again. Compared with the previous year, sales increased by nearly 12%. More importantly, this growth wasn't driven by accounting adjustments or one-time gains. The company maintained healthy volumes across its major product categories, while benefiting from more stable commodity prices and consistent demand. But revenue alone doesn't create wealth. Margins do. During the downturn, this was the biggest concern. Chemical companies often continue selling products, but at lower realizations. That destroys profitability. Now, the picture appears to be changing. EBITDA jumped by more than 50% year-on-year. Operating margins expanded from 19% to 25%. In manufacturing, that kind of improvement matters, because margins don't usually expand unless several things improve at the same time. Pricing becomes healthier. Plants operate more efficiently. Product mix improves, and fixed costs get spread over larger production. Then came the number that investors watch most closely: profit after tax. It rose by more than 60% compared to the same quarter last year. Even compared to the immediately preceding quarter, the improvement was dramatic. For the first time in many quarters, the business looked like it was regaining its operating strength. But smart investors never stop at the income statement, because profits can sometimes be temporary. Cash rarely lies. Balaji Amines continued generating positive operating cash flows even during the downturn. That tells us something important. Customers were paying. Operations were producing real cash. The business wasn't surviving on borrowed money. And speaking of debt, this is another area where Balaji Amines quietly stands out. Despite executing one of the largest expansion programs in its history, The company continues to maintain an exceptionally conservative balance sheet. Interest costs remain negligible. Debt levels are among the lowest in the industry. That financial discipline gives management something priceless. Freedom. Freedom to invest when competitors hesitate. Freedom to survive prolonged downturns. And freedom to capture opportunities when demand eventually returns. Another encouraging sign appears in operational efficiency. Working capital requirements have improved significantly. In simple terms, the company is converting its business cycle into cash more efficiently than before. That means less money remains locked in inventory and receivables over time. For manufacturing businesses, small improvements here often translate into meaningful improvements in return on capital. But before we become too optimistic, there are still important questions. Because recovery is not the same as full strength. Look deeper into the annual numbers, and the scars of the downturn are still visible. Revenue remains well below the record levels achieved during the previous chemical boom. Return on equity is still below 10%. Return on capital employed has fallen dramatically from its peak years. These are not numbers associated with a business operating at full potential. They're numbers of a company climbing out of a difficult cycle. Slowly, patiently, and perhaps deliberately. There's another point that deserves attention. Balaji Amines is investing heavily. Capital work in progress has increased substantially as multiple projects move toward completion. That means today's financial statements include the cost of expansion, but not yet the full benefits. The factories are being built. The capital has been committed, but much of the future revenue still lies ahead. This creates an interesting situation. The market isn't valuing only today's earnings. It is trying to estimate what those new plants could earn over the next 5 or even 10 years. That explains why some investors are willing to pay what appears to be an expensive valuation. They're not buying today's profits. They're buying tomorrow's capacity. Whether that optimism proves justified will depend entirely on execution. Can management commission every project on schedule? Can utilization ramp up quickly? Can margins remain healthy? Can the new specialty products command premium pricing? Those answers will decide whether Balaji Amines merely recovers or enters an entirely new phase of growth. Because in investing, a recovering company can become a good investment. But a recovering company with expanding capacity, improving margins, a strong balance sheet, and growing demand can sometimes become something far more valuable, a long-term compounder. In the next chapter, we'll step away from the financial statements and enter the world of institutional investors, technical charts, and smart money behavior to understand why the stock itself started moving before most investors noticed the recovery. The smart money moves before the headlines. There is an old saying on Wall Street: price leads news. By the time newspaper headlines become optimistic, by the time television experts begin recommending a stock, by the time quarterly profits become spectacular, the biggest money has often already been made. Professional investors know this. They don't wait for certainty. They look for evidence. Small clues that suggest something is changing beneath the surface. And when we look at Balaji Amines through that lens, a fascinating picture begins to emerge. For almost 3 years, the stock was trapped. Every rally was sold. Every recovery faded. It wasn't just a correction. It was a market that had completely lost interest. Volumes dried up. Momentum disappeared. And slowly, the stock slipped off most investors' watch lists. But markets rarely move from pessimism to optimism overnight. They move in stages. The first stage is silence. Prices stop falling. Not because buyers suddenly become aggressive, but because sellers slowly disappear. Then comes the second stage. The stock refuses to make new lows, even when the news remains negative. That is often the first sign that informed investors are quietly accumulating. Not loudly, not dramatically, patiently. One trade at a time. one institution at a time, one quarter at a time. When we applied our institutional screening framework to Balaji Amines, the stock didn't appear in just one screener. It appeared in 4. Growth Leaders Breakout, Institutional Launchpad, Smart Money Zone, Slanting Line Breakout. At first glance, those may sound like technical indicators, but each one represents a different phase of institutional behavior. The Smart Money Zone identifies stocks where accumulation often begins before obvious price strength appears. This is the phase where informed investors quietly build positions while public interest remains low. Then came the institutional launchpad. This is where accumulation becomes visible. Volumes begin improving. The stock starts outperforming weaker peers. The selling pressure that dominated the previous trend gradually disappears. Next, the stock entered the slanting line breakout screener. Technically, this is significant. For months, or even years, a stock trades below a falling trend line. Every rally is capped. Every attempt to move higher fails. Then one day, the trend line finally breaks. That moment matters, because trend lines are not just lines on a chart. They represent investor psychology. A descending trend line reflects persistent pessimism. Breaking above it signals that buyers are finally overwhelming sellers. But perhaps the most important signal came last. Growth Leaders Breakout. This screener doesn't simply identify recovering stocks. It identifies companies beginning to demonstrate leadership. There is a huge difference. Many businesses recover. Very few become leaders. Leadership requires something more: relative strength, institutional participation, and sustained demand. When all 4 signals appear together, they tell a remarkably consistent story. This is no longer just a technical bounce. It is a stock transitioning through the classic stages of institutional accumulation. The charts reinforce that conclusion. On the monthly time frame, the long-term downtrend has begun reversing. After years of weakness, the stock has reclaimed its major moving averages. Momentum indicators that had remained negative for months are finally turning upward. That is not common. Monthly trends change slowly. When they do, they often remain in place for extended periods. On the weekly chart, the picture becomes even stronger. A large base has already formed. The breakout is supported by expanding volume. Momentum continues improving. And importantly, the stock is making higher highs and higher lows. That is the foundation of every sustainable uptrend. The daily chart completes the picture. Instead of a vertical spike driven by speculation, the stock has been climbing through a series of consolidations. Each pause allows weak hands to exit. Each breakout attracts new buyers. This creates a healthier trend than a sudden explosion followed by exhaustion. Another clue lies in volume. Professional investors cannot buy millions of shares in a single day. They accumulate gradually. That process often leaves fingerprints. Unusually high-volume sessions, repeated accumulation days, and breakouts supported by expanding participation. Balaji Amines has begun displaying exactly those characteristics. Of course, technical analysis is not a crystal ball. Charts don't predict the future. They measure behavior. And behavior changes long before financial headlines do. That's why experienced investors pay attention to them. Not because charts know the future, but because they reveal what market participants are doing today. Still, no trend moves in a straight line. After a strong rally, some consolidation would be perfectly normal. In fact, it would probably be healthy. Great trends often pause before they continue. The real question isn't whether Balaji Amines will experience short-term volatility. It almost certainly will. The real question is whether the institutions accumulating today will continue buying tomorrow. Because when long-term capital begins building positions, they're rarely thinking about the next week. They're thinking about the next 3 to 5 years. And that may be the most important clue of all. Because the market has already begun voting. Now, in the final chapter, We'll answer the only question that truly matters. Is Balaji Amines simply a cyclical recovery story? Or could it become one of India's next long-term specialty chemical compounders? Recovery story. Or India's next specialty chemical leader? Voiceover. Every investment eventually comes down to one simple question. What happens next? Not what happened yesterday. Not what happened last quarter. But what the business could look like 5 years from now. Because the stock market doesn't reward history. It rewards the future. And that's exactly where Balaji Amines becomes interesting. Today, the company is not at its peak. Its revenues are still below the highs achieved during the last chemical boom. Its return on capital is nowhere near the extraordinary levels investors once admired. Its valuation looks expensive if you judge it only by today's earnings. In fact, many investors would look at a price-to-earnings ratio of nearly 46 and immediately walk away. And they wouldn't be completely wrong. On the surface, the stock isn't cheap, but experienced investors know something that beginners often overlook. Sometimes, the most expensive-looking stocks become the cheapest investments, not because their prices fall, but because their earnings rise. Imagine standing outside a factory under construction. The machinery isn't running. The production lines haven't started. Revenue hasn't arrived. If you value that factory based only on today's output, it looks overpriced. But if that factory begins operating next year, the same valuation suddenly appears very different. That is exactly where Balaji Amines stands today. The company has already invested heavily. New capacities are nearing completion. Higher value specialty products are entering the portfolio. The balance sheet remains strong enough to support expansion. And the latest quarterly numbers suggest that demand is beginning to improve. The market is trying to answer a difficult question. Will these investments simply maintain the business? Or will they fundamentally transform it? History offers an important lesson. The biggest wealth creators in specialty chemicals rarely grow because they sell more of the same products. They grow because they move higher up the value chain. Commodity chemicals compete on price. Specialty chemicals compete on technology, on quality, on reliability, on customer relationships, and most importantly, on margins. Balaji Amines appears to be moving steadily in that direction. Products like hydrogen cyanide, EDTA, acetonitrile, N-methylmorpholine, and dimethyl ether are not just additional products. They represent an expansion into areas where technical expertise matters more than scale alone. If management executes successfully, the company's revenue mix could gradually shift toward products with better profitability and stronger customer stickiness. That could change the economics of the business. Not overnight, but steadily. Of course, there are risks. Execution always looks easy on paper. Projects can be delayed. Demand can weaken again. Global chemical prices can fall. Chinese competition can intensify. And elevated valuations leave little room for disappointment. That is why no investment is ever guaranteed. But investing has never been about certainty. It has always been about probability. And today, the probabilities appear to be improving. The business has survived one of the worst downturns in the global chemical industry. Its balance sheet remains healthy. Its expansion program is nearing completion. Its margins have begun recovering. Its technical structure has turned decisively bullish. And institutional screens have started identifying it long before it has returned to peak earnings. That combination deserves attention. Not because success is guaranteed, but because it is increasingly difficult to ignore. Perhaps the biggest strength of Balaji Amines isn't any single financial ratio. It isn't the latest quarterly profit. And it certainly isn't the recent rise in the share price. Its greatest strength is something much harder to measure. Preparation. While others focused on surviving, Balaji Amines focused on building. While earnings were falling, new plants were rising. While investors were losing patience, Management was investing for the next cycle. History has a habit of rewarding companies that prepare during difficult times. The reward doesn't arrive immediately. It arrives when the cycle finally turns. Whether Balaji Amines becomes one of India's next great specialty chemical compounders or remains simply another cyclical recovery will depend on what happens over the next few years. But one thing is already clear. This is no longer the forgotten chemical company that quietly drifted through a downturn. It is a business entering a new chapter with stronger technology, larger capacity, a healthier balance sheet, and perhaps a future that is only now beginning to attract the market's attention. Because sometimes the biggest investment opportunities don't begin with spectacular numbers. They begin with subtle changes that only become obvious in hindsight. And if Balaji Amines delivers on the promises hidden inside its expanding factories, improving financials, and renewed institutional interest, this chapter may one day be remembered not as the end of its recovery, but as the beginning of its next era. Balaji Amines, the story behind India's silent chemical giant. What could go wrong? The risks every investor must understand. Every great investment story has two sides. One side is filled with optimism, growth, expansion, innovation, recovery. The other side is risk. And ignoring risk is often the fastest way to lose money. Because investing isn't about finding companies with no problems. It's about understanding whether the opportunity is larger than the risk. Balaji Amines is no exception. The company has many strengths, but it also faces challenges that investors should never ignore. The first is valuation. Today, the market is valuing Balaji Amines at nearly 46 times trailing earnings. For comparison, many well-established specialty chemical companies with stronger return ratios trade at similar or even lower valuations. So why is the market willing to pay such a premium? Because it believes the current earnings don't represent the company's true earning power. It is pricing in recovery. That can be rewarding, but it also creates pressure. When expectations become high, companies don't just need to perform. They need to outperform. Even a single disappointing quarter can trigger sharp corrections. The market forgives weak numbers when expectations are low. It rarely forgives them when expectations are high. The second risk lies in return ratios. A few years ago, Balaji Amines was generating extraordinary returns on capital. Today, return on capital employed has fallen close to 11%. Return on equity remains below 10%. Those numbers tell us something important. The company has not yet converted its recent investments into higher profitability. New factories alone don't create shareholder wealth. Only profitable factories do. That is why the next 2 years will be critical. The third risk is execution. The company has announced one of the largest expansion plans in its history. New products, new technologies, new manufacturing facilities, new specialty chemicals. It sounds exciting, but every expansion carries uncertainty, construction delays, cost overruns, lower than expected demand, operational challenges. These are realities every manufacturing company faces. A delayed project doesn't simply postpone revenue. It also delays cash flows and increases pressure on returns. Then comes an external risk that management cannot control. China. The global chemical industry has repeatedly experienced price disruptions caused by excess Chinese capacity. When domestic demand weakens, Chinese manufacturers often increase exports. Prices fall, margins compress, and producers around the world feel the impact. Balaji Amines has already experienced this once. There is no guarantee it won't happen again. The company's move toward higher value specialty chemicals may reduce that risk over time, but it cannot eliminate it completely. Another factor deserves attention. Foreign institutional investors have gradually reduced their shareholding over recent quarters. Does that automatically mean something is wrong? Not necessarily. Institutional investors sell for many reasons: portfolio rebalancing, global risk reduction, country allocation, currency movements. It isn't always a judgment on a company's future. Still, until institutional ownership stabilizes, it remains something worth monitoring. There is also the question of promoter pledge. Although the company enjoys a healthy balance sheet, part of the promoter holding remains pledged. Today, it is manageable. But ideally, investors would like to see that pledge reduce over time. Because lower pledging always improves confidence. Perhaps the biggest risk of all is psychological. Recovery stories often create excitement. Every improving quarter fuels optimism. Every breakout attracts new investors. And suddenly, people begin believing the stock can only move in one direction. History teaches us otherwise. Even the strongest long-term winners experience corrections. 10%, 20%, sometimes even 30%. Not because the business has changed, but because markets never move in straight lines. Patience becomes the greatest competitive advantage. The best investors rarely chase rallies. They build positions gradually. They allow volatility to work in their favor. And they remain focused on the business rather than the daily price. Because in the end, the biggest risk isn't that Balaji Amines faces challenges. Every business does. The biggest risk is assuming that recovery is guaranteed. Recovery must be earned, quarter after quarter, project after project, execution after execution. And that is exactly what makes the coming years so fascinating. Because if management delivers, today's concerns could become tomorrow's forgotten headlines. But if execution falters, the market will respond just as quickly as it rewarded optimism. That is the reality of investing. Not certainty, probability. And Balaji Amines now stands at the intersection of both. In the final chapter, we'll step back from the numbers, the charts, and the headlines to answer one timeless question every investor asks. If this company disappeared tomorrow, would the world even notice? Because sometimes, the answer to that question reveals more about a business than any balance sheet ever can. The invisible company that India cannot afford to lose. Imagine waking up tomorrow, and Balaji Amines no longer exists. No factories, no production, no supply, nothing. At first, most people wouldn't even notice. The stock market would move on. Television channels would barely mention it. There would be no long queues outside its offices. No customers demanding refunds. Because Balaji Amines doesn't sell directly to consumers. Its name isn't printed on the products we buy. But within weeks, the impact would begin to spread. Pharmaceutical manufacturers would scramble to source critical raw materials. Agrochemical companies would search for alternative suppliers. Water treatment businesses would face shortages. Rubber chemical producers would look overseas. Import bills would rise. Lead times would increase. And many manufacturers would once again become dependent on foreign suppliers. That is the paradox of businesses like Balaji Amines. The less visible they are, the more essential they often become. They don't build brands. They build ecosystems. And ecosystems are difficult to replace. This is why chemical manufacturing is strategically important. Every developed economy eventually realizes the same truth. A nation that cannot manufacture critical chemicals cannot truly control its industrial future. Because chemicals sit at the beginning of thousands of supply chains. Before medicines are made. Before fertilizers reach farms. Before specialty plastics are molded. Before electronic components are assembled. Chemicals come first. And among those chemicals, amines occupy a surprisingly important position. For decades, India depended heavily on imports for several specialty molecules. Every disruption in global trade exposed that weakness. Every supply chain shock reminded industries of the importance of domestic manufacturing. Companies like Balaji Amines are changing that equation. Not by making headlines, but by making India more self-reliant. One product, one technology, one manufacturing process at a time. That may never become a viral news story, but it quietly strengthens the country's industrial foundation. Of course, national importance alone doesn't create shareholder returns. Businesses create returns through execution. And that's exactly where Balaji Amines now finds itself. The easy part is over. Building factories is difficult, but operating them efficiently is even harder. The company must now prove that every rupee invested, every new production line, every specialty product can generate higher revenues, better margins, and stronger returns on capital. Investors have already started believing that possibility. The stock has begun responding. Technical trends have turned positive. Institutional interest is reappearing. The market has started looking beyond yesterday's earnings. Now, management must justify that optimism. Because markets can be patient. But not forever. If the new capacities ramp up successfully. If demand continues recovering. Businesses with durable competitive advantages. That transformation, more than anything else, will decide the next decade. So, what have we really learned? We've learned that this is not a story of explosive growth. It's a story of resilience, not a company chasing headlines, but one quietly strengthening its foundations while the industry struggled. We've learned that great businesses are often built during difficult years, not easy ones. And perhaps most importantly, we've learned that the market often notices change long before most investors do. Sometimes, the first clue appears in a quarterly margin. Sometimes, in a factory under construction. Sometimes, in a breakout on a price chart. And sometimes, in the quiet confidence of a management team that keeps investing when everyone else is cutting back. Will Balaji Amines become India's next great specialty chemical compounder? No one can answer that with certainty. Markets don't offer guarantees, only probabilities. But the company has something every long-term investor looks for. A business with technological expertise, a healthy balance sheet, expanding capacities, improving operating performance, and an industry that could benefit from India's growing focus on domestic manufacturing and import substitution. The rest will depend on execution. Because in the end, stocks may rise on expectations, but companies create wealth through performance. And somewhere inside those expanding chemical plants, inside those new production lines, and inside those molecules that most of us will never even see, the next chapter of Balaji Amines is already being written. The market has noticed. The institutions appear to be watching. Now, only time will reveal whether this quiet chemical giant becomes one of India's defining industrial success stories, or simply another company that promised more than it delivered. Until then, the story remains unfinished. And perhaps, that's what makes it worth watching. Why Balaji Amines could become a multi-bagger, or miss the opportunity. The next 5 years will decide everything. If you've stayed with this story until now, you've probably realized something. Balaji Amines isn't just another chemical company. It's a company standing at a crossroads. One road leads to steady growth. The other could lead to something much bigger. History shows that India's biggest wealth creators weren't always the largest companies. Many started as niche manufacturers. They dominated a small market, built technical expertise, expanded into higher value products, increased margins, generated strong cash flows, and then the market slowly re-rated them. Companies like Pidilite, SRF, Vinthi Organics, Deepak Nitrite didn't become market leaders overnight. Their transformation took years. Balaji Amines now hopes to write a similar story. But there's one important difference. Those companies didn't become successful because they built bigger factories. They became successful because they kept moving higher up the value chain. Every new product solved a more difficult problem. Every expansion carried higher margins. Every innovation made them harder to replace. That is exactly the journey Balaji Amines has begun. Its traditional amines business built the foundation. Its derivatives improved profitability. Now, its focus is shifting towards specialty chemicals, products where customers don't simply ask, "Who is the cheapest supplier?" Instead, they ask, "Who can consistently deliver the right quality?" That's a completely different business. And it's a far better business. Because quality creates trust. Trust creates long-term relationships. And long-term relationships create pricing power. That is where real wealth is created. But here's the challenge. Every company talks about expansion. Every company talks about future growth. Very few actually deliver. For Balaji Amines, the next 3 years won't be judged by announcements. They'll be judged by numbers. Can the new plants run at high utilization? Can specialty chemicals become a larger share of revenue? Can operating margins consistently remain above 20%? Can return on capital climb back toward 20%? Can earnings compound faster than revenue? If the answer to those questions is yes, today's valuation may eventually look reasonable. If the answer is no, the market will quickly lose patience because expectations have already begun rising. Another factor could quietly work in the company's favor. India. Over the past decade, India has steadily moved from being just a consumer of chemicals to becoming a serious manufacturing hub. Global companies are diversifying supply chains. Governments are encouraging domestic production. Import substitution has become more than just a policy slogan. It has become an industrial strategy. For companies like Balaji Amines, this creates a rare opportunity, not just to replace imports, but to become exporters of technology-intensive chemicals. That transition, if executed successfully, can fundamentally change the company's scale. Then comes perhaps the most overlooked advantage of all: experience. Balaji Amines has spent decades mastering complex chemical processes. That knowledge cannot be copied overnight. Factories can be built. Machines can be purchased. But process expertise, operational discipline, and customer trust take decades to develop. Those invisible assets rarely appear on a balance sheet. Yet they often become a company's greatest competitive advantage. So, where does that leave investors? Not with certainty, but with a framework. If quarterly earnings continue improving, if new projects start contributing, if return ratios recover, and if institutional ownership begins increasing again, the probability of long-term wealth creation rises significantly. If those milestones fail to appear, the investment thesis weakens. It's that simple. Because in investing, the best decisions aren't made by predicting the future. They're made by continuously observing whether the original thesis is becoming stronger or weaker. Balaji Amines has now entered that critical phase. The foundation has been laid. The capital has been invested. The factories are nearing completion. The early signs of recovery are visible. Now comes the hardest part: execution. And perhaps that's what makes this company so compelling. The biggest chapter in Balaji Amines' history hasn't been written yet. It isn't hidden in its past. It's waiting in its future. And 5 years from now, investors won't remember the quarter when profits first recovered. They'll remember whether this quiet chemical manufacturer transformed itself into one of India's enduring specialty chemical leaders. The hidden moat: why competitors can't easily replace Balaji Amines. The advantage you won't find on the balance sheet. When investors hear the word chemical company, they often imagine one thing: a commodity business. One company makes a chemical. Another company makes the same chemical. Customers buy from whoever offers the lowest price. Simple. But reality is far more complicated. Not every chemical is a commodity. Some chemicals are commodities because anyone with enough capital can manufacture them. Others require decades of expertise, years of process optimization, strict quality control, and deep customer relationships. Balaji Amines belongs increasingly to the second category. Its biggest competitive advantage isn't visible in its factories. It isn't reflected in its quarterly profits. And it certainly doesn't appear on its balance sheet. Its biggest advantage is knowledge. Think about it this way. If someone handed you the blueprint of a Formula One car, could you build a championship-winning machine tomorrow? Probably not. Because success isn't just about having the design. It's about understanding every tiny detail that makes the design work. Chemical manufacturing follows the same principle. A molecule may look simple on paper, but manufacturing that molecule consistently, safely, economically, and at industrial scale is an entirely different challenge. One slight variation in temperature, one impurity, one process failure, and an entire production batch may become unusable. That is why customers in industries like pharmaceuticals and agrochemicals don't simply buy chemicals. They buy reliability. Imagine you're a pharmaceutical company producing life-saving medicines. Would you change your raw material supplier simply to save a few rupees? Probably not, because the cost of failure is enormous. Every new supplier requires testing, validation, regulatory approvals, stability studies. Sometimes those processes take months, sometimes years. That creates what investors call switching costs. Once a customer trusts a supplier, changing that relationship becomes difficult. This is where Balaji Amines quietly benefits. Over decades, it has become deeply integrated into the supply chains of multiple industries. Its products flow into pharmaceutical companies, agrochemical manufacturers, water treatment businesses, rubber chemical producers, and specialty chemical companies. Each customer relationship represents years of trust. Trust that competitors cannot easily buy. Then there is technology. Balaji Amines isn't simply manufacturing one product. It manufactures an entire family of amines and derivatives. Each new derivative increases the value extracted from the same raw materials. Think of crude oil. One barrel of crude doesn't become just petrol. It becomes diesel, jet fuel, lubricants, bitumen, petrochemicals. Each additional product creates more value. Balaji Amines follows a similar philosophy. One base chemical becomes multiple specialty products. Each step moves further up the value chain. Each step increases margins. Each step reduces dependence on a single market. This is why management continues investing in downstream products rather than relying only on volume growth. Because downstream integration creates a business that's harder to compete against. Another hidden advantage lies in scale. India's chemical demand continues growing every year, but very few companies possess the capacity, infrastructure, and technical expertise to serve large industrial customers consistently. Balaji Amines has spent decades building exactly that capability. Large production facilities, integrated manufacturing, established logistics, technical support, customer relationships. None of these were created overnight. Together, they form an economic moat, not an unbreakable moat, but a meaningful one. Of course, no moat lasts forever. Competitors can invest. Technology evolves. Markets change. The only sustainable advantage is continuous innovation. And that is perhaps the biggest question for Balaji Amines. Can it continue moving into high-value specialty chemicals before competitors catch up? Can today's technological leadership become tomorrow's pricing power? Can innovation become a habit rather than a one-time achievement? Because history is full of companies that built great businesses, only to stop evolving. And eventually, the market moved on without them. The winners are those who keep reinventing themselves. Perhaps that's why the current expansion matters so much. It isn't just about producing more chemicals. It's about producing better chemicals, more complex molecules, higher value products, solutions that customers cannot easily replace. If Balaji Amines succeeds, its future may look very different from its past. Not simply larger, but stronger, more resilient, more profitable, and more difficult to compete against. Because in business, the greatest competitive advantage isn't being the biggest. It's becoming the company that customers cannot afford to lose. In the next chapter, we'll explore the biggest opportunity that could reshape Balaji Amines over the coming decade. Not inside its factories, but in the changing global supply chain that's quietly shifting toward India. The China Plus One opportunity. Why the world is looking beyond China. Can Balaji Amines ride India's biggest manufacturing shift? For decades, the world depended on one country for chemicals, China, from basic industrial chemicals to highly specialized molecules. China became the factory of the world. Its advantages were overwhelming. Massive scale, low manufacturing costs, integrated supply chains, government support, and the ability to produce almost everything under one roof. For years, very few countries could compete. If a global company needed a chemical, China was often the first choice. But history has a way of changing direction. The COVID-19 pandemic exposed a weakness that businesses had ignored for years. What happens when the world's supply chain depends too heavily on a single country? Factories stopped, ports slowed, shipping costs exploded, critical raw materials became unavailable. For the first time in decades, global manufacturers realized that efficiency alone wasn't enough. Resilience mattered too. Companies around the world began asking a different question. What if China can't supply tomorrow? That single question gave birth to one of the biggest industrial trends of this decade. China Plus One. The idea is simple. Don't replace China. Reduce dependence on China. Manufacture in multiple countries. Diversify supply chains. Lower geopolitical risk. And build resilience. India quickly emerged as one of the strongest alternatives. Not because it was cheaper, but because it offered something equally valuable. Stability, a large engineering workforce, growing domestic demand, and government support for manufacturing. Over the past few years, global pharmaceutical companies, agrochemical manufacturers, electronics firms, and specialty chemical businesses have steadily increased their presence in India. Some shifted sourcing, others invested directly. Many began qualifying Indian suppliers for products they had previously imported almost entirely from China. For companies like Balaji Amines, this could become a defining opportunity because Balaji Amines isn't entering a new industry. It already manufactures products that India imports in significant quantities. Many of its upcoming projects are focused on exactly those molecules: hydrogen cyanide, sodium cyanide, EDTA, acetonitrile, N-methyl morpholine, products where domestic manufacturing can reduce import dependence while strengthening India's industrial ecosystem. But here's what makes the opportunity even bigger. Import substitution is only the first step. The real prize is exports. Imagine a global pharmaceutical company looking for a second supplier outside China. Would it prefer a company that merely trades chemicals, or one that has decades of manufacturing expertise, integrated production, strong quality systems, and a proven operating history? That is where Balaji Amines could gradually strengthen its position. Because once international customers approve a supplier, relationships often last for years. Changing suppliers in regulated industries isn't easy. It requires testing, audits, validation, and regulatory approvals. That creates long-term business opportunities. Of course, China won't simply surrender its dominance. Chinese manufacturers remain highly competitive. They possess enormous scale, advanced infrastructure, and deep experience. Competing against them requires far more than patriotic optimism. It requires efficiency, technology, quality, and relentless execution. That's exactly why Balaji Amines' strategy matters. Instead of competing only on volume, the company is expanding into higher-value specialty chemicals, products where customer relationships and technical expertise matter more than just price, products that are harder to copy. harder to replace, and often far more profitable. There is another reason this trend matters. India itself is becoming a much larger consumer of specialty chemicals. As pharmaceuticals expand, as electric vehicles grow, as water treatment becomes more important, as agriculture modernizes, demand for specialty molecules is likely to increase. That means companies like Balaji Amines don't have to rely only on exports. They can benefit from both domestic growth and global diversification. That combination is powerful. But opportunities alone don't create wealth. Execution does. Every company talks about the China plus one opportunity. Only a handful will actually capture it. The winners will be those with the right products, the right technology, the right customer relationships, and the discipline to scale without compromising quality. Balaji Amines has spent decades building those foundations. Now, the global environment may finally be moving in its favor. Whether that becomes a transformational opportunity or simply another missed chance will depend on what management does over the next few years. Because history doesn't reward companies for recognizing opportunities. It rewards companies that execute on them. And perhaps, years from now, investors won't remember this period as the time when the world began moving beyond China. They'll remember it as the moment when companies like Balaji Amines quietly stepped onto the global stage. Top of form. The difference between building a company and building shareholder wealth. Every successful business eventually reaches a moment where the numbers alone are no longer enough. Revenue can grow, factories can expand, profits can recover. But one question still remains. Can investors trust the people running the company? Because markets don't invest in factories. They invest in management. A world-class business with poor management can destroy enormous wealth. But an average business with exceptional management can surprise everyone. So, where does Balaji Amines stand? Let's begin with something that often goes unnoticed. For decades, Balaji Amines has stayed focused on one thing: chemistry. It didn't diversify into unrelated businesses. It didn't chase fashionable industries. It didn't buy companies simply to appear larger. Instead, it stayed within its circle of competence. It expanded deeper into amines, then derivatives, then specialty chemicals. Every expansion built upon the previous one. That may sound obvious, but in corporate India, it is surprisingly rare. Many companies lose discipline when cash flows improve. They enter real estate, power generation, telecom, financial services, businesses they barely understand. History has shown how expensive those.
Don't forget to like and subscribe.